Hello, everybody, and welcome to the Capital News. I am your host, Alex Karitis. And for the economic news for February the 13th, 2019, let's get into some of that data for the day on the stock market. Pretty tepid day on the U.S. markets. Nothing overly exciting, not a huge bunch of rumors that were dropped that catapulted this market a few hundred points like it did the other day. Rather calm. No major pullback, no major retest of any of the lows, nothing like that. Just a nice, calm, somewhat peaceful day. I guess we'll take that. But the S&P 500 closed up about 8 points. Dow Jones Industrial Average closed up 118. NASDAQ was up about 6 points. The Russell 2000, the small cap index, closed up around 5 points. And then in the oil, gold, and silver markets, we had some small, minor news, nothing to write home about. Not a whole bunch of excitement there, although we have heard that the Saudis will continue with their cutting of oil production, so we'll see what that does to the price moving forward on WTI and Brent, which is the international market that really looks at the oil price there. You have WTI, for those of you who may not know, WTI is West Texas Intermediate, which is really U.S. based. And then you have Brent, which is more of the international gauge for oil. And there's usually a spread between the two, with Brent being more expensive per barrel than WTI. And then if we look at the 10-year Treasury, we had a further increase in the yield, and we now stand at 2.71%. So there was some more continued selling there in the Treasury market. So I don't know if this means we are back to a risk-on trade after yesterday's rally. What's going on? You always have to look back and forth between the equity markets and the bond markets to sort of see both sides of the coin here. Again, you have the adults in the room in the bond market, and then you have the crack addict, spoiled kids in the stock market. It's a constant struggle. A lot of times the kids get their way, as we're seeing here. So that's the news in the markets. Like I said, nothing overly exciting, nothing to write home about. But we do, of course, what would be a day without having some sort of rumor or discussion that didn't revolve around the U.S. trade talks? Well, don't worry, we had something. Now, according to Bloomberg News, shortly before the recording of this podcast, there is a possible 60-day extension. Did you hear that? A possible 60-day extension to the trade talks. That's going to take us into May. We're going to be on this roller coaster ride until May. If everything was fine, if we were so close to a deal, then why would we need a possible 60-day extension? And don't get me wrong, I am not saying that this is what's happening. This is what is being considered. This is what the news breaking from Bloomberg has reported. That the White House is weighing the possibility of a 60-day extension. If he wanted to meet soon, remember that was Kellyanne Conway's comment that moved the markets a few hundred points. The president wants to meet with President Xi of China soon. Well, I told you, what the hell does that mean? The deadline was supposed to be March 1st, March 2nd. We're 2 weeks away. That's soon. Was he going to meet with him before he met with Kim Jong-un of North Korea, which is to take place February 27th and 28th in Vietnam? I don't think so. So what did soon mean? Nobody knew, but nevertheless the markets rallied. So, given recent history, since the G20 meeting in Buenos Aires, Argentina, we were told There's going to be a 90-day wait and see, a 90-day negotiation period. Deadline, March 1st. Boom. No questions. We're tough here. You have, obviously, conflicting reports. Something comes out of the White House. Phenomenal. Everything's great. China loves us. Markets go up. We're close to a deal. Then you have somebody else who's actually a part of the trade delegation say, no, that's not true. High hopes, then you get deflated. High hopes, then you get deflated. And this has happened over and over and over again. My podcast is new. I'm only a couple weeks old at this point. I've had several podcasts already where I sound like a broken record. And now we're going to hear this broken record for another 60 days. If that turns out to be the case. Because this market does not have a catalyst for growth. It just doesn't. There's nothing here. You had the markets enter bear market territory in the fourth quarter of 2018. We have had a V-shaped recovery since then. 7 straight weeks of gains on these markets. 7 straight weeks. That's phenomenal. It's also probably unsustainable. But don't quote me to that and don't hold me to it, because this whole thing is rigged. This whole thing is a charade. We are in a trade war. This is all propaganda. The U.S. wants to keep its markets up. The Chinese want to keep their markets up. The U.S. wants to say, Federal Reserve, keep the pedal to the metal. Keep the pedal to the metal. Pump that money, baby. Pump that money. Because we need it to keep these markets up, because we can't give the Chinese leverage to say, look, you're suffering from these tariffs. Your market's tanking. And likewise, the Chinese are doing the same thing. Talking about huge amounts of tax cuts. Want to double the amount of foreign direct investment. They are hurting for cash. The supposed Chinese economic miracle is a nightmare. The supposed U.S. economic miracle just ain't true. You don't have $22 trillion in debt. You don't have trillion-dollar deficits. You don't have recession-era interest rates in a strong economy. You just don't have it. That's just the reality of it. As much as many of you may like Donald Trump, and there's a lot about the man I like, but when it comes to this economy and all of this talking it up, it's simply propaganda, because we're in a trade war. The numbers just aren't there. There are some good things. I don't want to say this is all doom and gloom. There are some good things, most definitely. But it is not near as strong as the president wants you to believe. I would much prefer an adult in the room. I would much prefer a real conversation where people can be prepared for what's coming and what's really going on. I spoke to you yesterday on the report from the New York Federal Reserve. The report that showed that auto loan delinquencies 90 days or more past due have hit an all-time record since the report has been recorded. 7 million people. 7 million people. 90 days or more past due on their auto loans. That's not good any way you cut it. That is not a good sign. You had the University of Michigan's consumer sentiment last month come out. The lowest it has been since President Trump's presidency. Now, there might be some recency bias in that, and we'll see what happens with the February numbers. Recency bias being the fact that the fourth quarter was very volatile and very much to the downside. So because that was recent, some people may be biased to say, well, things aren't good or aren't going to be good. And so they have a more negative perception of what's going to take place in the future. But we'll see if that's abated in the February numbers. But what we do know on the Chinese side is their numbers aren't any good either. Whether it's exports and imports, whether it's the amount of debt that's on the government books, it's on corporate books, that's on the consumer's balance sheet, it's just not good. You can't continue to kick the can down the road, especially when you're running out of road. So now we're in a place where we may have a 60-day extension in this U.S.-China trade war, even though we were told everything was going well and that they were going to meet soon. Now we have to push it off another 60 days. This is getting ridiculous. How much more of a rally are we going to get based off of hope that there is a trade deal that actually means something? I mean, if this really goes to May and you just sort of extrapolate these last few months, really these last 7 weeks, I mean, this thing could make new highs based off of nothing but rumors that we're going to meet, that we're going to sign a deal, it's going to be the best thing ever. Best thing since sliced bread. In that now the Chinese economy is going to be back. It's going to be a roaring tiger. And the U.S. economy, it's going to come back with a vengeance. Why? Because we've removed 10%, a 10% tariff on a bunch of cheap crap that comes from China that we don't need to be buying, that we can't afford now with the fact that it's 10% higher. We couldn't afford it when it was 10% cheaper. We don't need it. But if and when those tariffs get removed, I mean, everything's going to be okay. I don't buy that argument for a second because it doesn't make any sense. If everything we bought was from China, if everything that China purchased was from the U.S., well, then maybe you have a better argument. But that's not the case, not even close. Not for a second. We have to get real here. And I've told you, the meat and potatoes of this whole trade war isn't even to do with the tariffs. That's a negotiating tool to get them to the table, to make a move, see if something can get done. The meat and potatoes is the IP. It's the industrial corporate espionage. And then you have to ask yourself a serious question. The Chinese are playing a long game here. President Trump is attempting to play a long game. But the president has 2 more years left on his term as president. If he wins re-election, okay, that's 6 years. President Xi may be the president of China for the rest of his life. And then he'll say, hell, Trump, they might say he has no chance of winning in 2020. They like taking advantage of the U.S. They like stealing our company's IP. They like it. They like the corporate espionage. They like figuring out how we do things, because they can't. And so they'll just stall for time. Maybe that's what this first move is. Maybe they're being quote-unquote respectful to the President of the United States just so they can buy a 60-day extension. You get what I'm saying here? They're playing the long game. They might say President Trump is not. And if you think that Russia interfered with the presidential election, just wait and watch to see what the Chinese do in 2020, especially if they don't want to bow and cave in on changing their ways when it comes to corporate espionage, industrial practices, and IP. Wait for that one, and we'll see how much of a hissy fit is thrown in the media for that. we'll see how self-righteous all these Democrats become on protecting a whole bunch of jobs and corporations in this country when the Chinese intervene in these elections. Because they don't want to cave. So that's more news. I'll keep you updated. Obviously, we'll see if that becomes a statement of fact, that the 60-day extension is a real thing. But that's what we can expect if it does prove to be true. We'll continue to see rumors. We'll probably continue to see the market rally off of those rumors. And then, if it is buy the rumor, sell the fact, then you may see a little bit of a sell-off if and when something actually is agreed to. This is more nonsense, but it's unfortunately par for the course. Now, moving on, because I do want to talk about some other things. I'm probably going to break this down. Well, I am going to break this down over the course of several podcasts because it's a long list. This is a list that was created by Deutsche Bank. And it's 30 risks to markets in 2019. They developed this list in the latter part of 2018. So I'll break this down over a few podcasts, go through them one by one, and then just sort of talk about each one and how it relates to what's currently going on, what was going on, and what's likely to happen as we progress through 2019. So the first point on their list, and I don't know if they rank these. I think these is just a list of 30 things. So don't put any more weight on anything as I go down the list. So the first one is algo-driven, risk parity-driven fire sale in equities and credit continues. So obviously this is relating to a whole bunch of computer-driven trading in response to what was going on in Q4 of 2018. A lot of the developments in algorithms and computer-based trading has obviously made leaps and bounds over this last decade, as has so many other technologies. So this is no exception. That shouldn't be a surprise to anybody. I'm not going to sit here and pretend to be an expert on algorithms. I am not a computer scientist. I am not a mathematician that looks at these things. I don't develop these things. And obviously this is very proprietary and secret to a lot of these trading firms. But what we do know is over the last 10 years, this has been a bull market. So these algorithms and a lot of these models have been based off of situations that have just continuously fueled this fire. This is zero interest rate policy. This is quantitative easing. See what I'm saying here? If these models are all built off of that assumption being at the base, or at least a significant chunk of the piece of the puzzle, and that starts to get taken away, as we saw at the end of 2018, we saw markets enter bear market territory. So what Deutsche Bank is saying here, and this is a real concern, is if these machines have basically been trained to just buy, and bid all these stocks up, and they've been on a tear for the past 10 years. Again, if you bought anything, you look like a genius. What happens if economic conditions deteriorate and earnings start to crash and margins start to tighten? What are these machines going to do? Are they going to sell as vigorously as they have been buying? And if so, what does that mean for the markets? That's a big concern. Because most people, and even when you watch a lot of interviews on Bloomberg or CNBC or Fox Business, you have a lot of funds out there that don't even engage in algo-driven trading. And these people are managing a ton of money, have a ton of experience, and they don't know what's going on with these algorithms and how they operate and function. So will it be a panic sell? Will selling beget more selling? Depending on the economic conditions, it very well may. So I have to agree with Deutsche Bank in that being a serious risk to monitor. Moving down the list, we have slowing growth in China and Europe, which translates into slowing down the U.S. economy. Well, we know for certain that the Chinese economy is slowing down. We've seen it in the numbers. We've had it from government officials, government regulators. There's no hiding it. Of course, they still claim officially that the economy is growing at 6.5%, which is admirable by any definition. Is it true? I have serious doubts that those numbers are accurate. But nevertheless, even the fact that it's 6.5% yearly growth, it is a Chinese slowdown. We also know for a fact when it comes to Europe that Italy has entered a recession. We know that German economic data is pointing to the same direction. Will it be severe? Will it be prolonged? That remains a question, and that's why it's on this list. We continue to have the Brexit drama. Is there going to be a deal? Is there going to be no deal? We have a month and a half. But what we do know is that the Bank of England has cut the forecast. And at this point, they refuse to be hawks and increase interest rates. And we know from previous discussions that they are not going to raise interest rates probably for a year or two. And if and when they do, it will only be 25 basis points. So that'll most definitely have an effect on the U.S. economy. That'll definitely trigger things over here, especially if it's a financial crisis in some of those banks. So that's number 2. Number 3, slowing growth in China and Europe triggering significant U.S. dollar appreciation. So why is this a concern? Well, if you have significant U.S. dollar appreciation, this can affect, obviously, corporate earnings, especially for those corporations that earn a lot of money overseas. That can have an effect on earnings. And then the other thing that becomes a concern is what does this do to emerging markets, and particularly emerging market debt? Because if emerging market debt is priced in dollars and you have a stronger dollar, that means the emerging market currency has decreased in value. So now it's going to take more of their domestic currency to pay off their U.S. denominated debts. So now that eats into their margins to pay all of those debts off. So you may have a downward spiral in emerging markets because they are not immune to this debt disease that everybody else is suffering from. And if you have a U.S. dollar that is appreciating, most major commodities around the world are traded in U.S. dollars. So if you have a stronger dollar, you're going to have weaker oil prices, weaker iron ore prices, maybe weaker copper, weaker aluminum, whole host of commodities. Well, emerging markets, most of them, that's their bread and butter. So if they have lower costs for their primary goods that they are selling to the rest of the world, which coincidentally is also slowing down, so now you have weaker demand, you have a lower price, and it's taking more of your home currency to pay off U.S. denominated debts, that's a triple whammy. And as we've seen, despite the fact that Jay Powell and the Federal Reserve have done a 180 and have become a lot more dovish, so have other central banks around the world. So while there may have been a short-lived decline in the dollar, we have now seen trading day after trading day where the dollar just gains against the basket of currencies. Now, today it was a little mixed. But as I said in a previous podcast, there was, I think, the longest streak in 3 years of trading gains for the U.S. dollar. So that's a concern because it's just how everything is connected. And that's something that I have to stress over and over again because it's so important, and you have to understand it. No country anymore is an island. We are all connected. Number 4 on this list, tailing U.S. Treasury auctions and or declining bid-to-cover ratio. So what this means is there's not a lot of demand, potentially, for U.S. Treasuries. Well, what's that mean? Well, if there's not a lot of demand for U.S. Treasuries, that means that Uncle Sam is going to have to increase the interest rate. That interest rate on that debt is going up to entice people to come in and start buying the bonds. That's not a good thing. When you have $22 trillion in debt, when you have a lot of debt that's coming due over the next few years here, and you want to refinance that debt or issue new debt, I mean, you want those interest rates to be as low as possible. And I've spoken previously about how we are in a position where we have countries who are buying less U.S. Treasuries. Japan's buying less, Russia's buying less, China's buying less, because this debt bomb that exists the world over is coming home to roost. And the appetite for other countries' debt is waning. So we have $3 trillion that comes in tax revenue. We spend an additional $1 trillion, so that's $4 trillion we spend every year. Have very little to show for it. And our interest payments alone are several $100 billion. If interest rates go up a little bit, just a little bit, that number can skyrocket. And that's just the interest payments. That's not the principal, that's just the interest payments. Now, the Federal Reserve may be able to come in and manipulate them as much as they want, but I've said on previous shows, what happens if the market says, not this time, I'm done? What about the effectiveness or lack thereof, the diminishing marginal returns on additional rate cuts or quantitative easing? That's a big risk. That's what Deutsche Bank is starting to talk about here. And that goes to the other points that they make, 5 and 6. Point 5 is increased U.S. T-bill issuance continues to push 3-month LIBOR-OIS wider. So those are credit spreads. You have wider credit spreads, that sort of indicates there's some trouble going on. There's a problem with liquidity. There's a problem with credit. Credit, liquidity, that's the lifeblood of this economy. That's why we got so much funny money floating around there. If that continues to be a problem, look out. Is there going to be another financial crisis? Well, if you look at European banks, it's most definitely a possibility. And then point 6, increased U.S. Treasury issuance pulls out investment-grade credit and equities. Uncle Sam needs a buyer. Come on, guys. Get out of the corporate debt market. Get out of equities. Be patriotic. Dun, 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 dun. And buy U.S. Treasuries. Because we can't afford higher interest rates. So you could have corporate markets collapse, corporate bond markets collapse. You could have stock markets collapse. If there needs to be a flight to safety for all of these other reasons. And so they jump into U.S. Treasuries thinking that's a safe haven. How safe it is, I don't know. It's probably safer than some really junky corporate bonds out there. And some risky stocks. I mean, this is only 0.6. We got 24 more to go. You look at the list in its entirety, and I suggest that you do. I mean, you can just Google it, Deutsche Bank's 30 risks for 2019. Take a look at it, think about it, and I'm going to continue this discussion. I thank you guys for joining me. Regardless of where you're listening or watching, whether it's YouTube or thecapitalnews.com. And of course, that's thecapitalnews.com, capital with a K. Please like, share, subscribe, get the word out. Love to hear from you. Post comments. Let's make this interactive. And we'll see you next time. This is the Capital News. I'm Alex Kreitis. Godspeed.